All right, let's dive right in. Today we're going to tackle a theory that completely flips one of the biggest ideas in finance on its head. It suggests that underneath all the noise and chaos of the market, there's actually a hidden, predictable rhythm.
So let me ask you this. Are the markets really just random? I mean, for decades, that's been the great debate, right? Is every single price tick just a chaotic, unpredictable event? Or is there something more? A hidden pattern? Maybe even a code? Just waiting to be cracked? Well, back in the 1930s, right in the middle of the Great Depression, a time of absolute financial chaos, one man came up with a very different answer. His name was Ralph Nelson Elliott. And while everyone else was looking at the market charts and seeing nothing but a total mess, he saw something else entirely. He saw order. So here's what we're going to cover. We'll start with the story of how this whole thing came about. Then we'll get into the nuts and bolts of the 8-wave cycle. We'll talk about the psychology behind it, how people actually trade with this stuff, and finally why an idea from the 1930s is still such a huge deal today. Okay, let's kick things off with the discovery itself. You've got to wonder, right? How does a retired accountant, of all people, end up cracking the secret language of Wall Street? Well, it's an amazing story of just pure, relentless observation. So the story goes, Elliott had to retire early because of a health issue, and he was looking for something to keep his mind sharp. So what does he do? He dives headfirst into the stock market. And we're talking about years spent poring over 75 years worth of charts. And after all that time, something incredible started to emerge from the noise. And this was his big breakthrough. He realized he wasn't really looking at stock prices. He was looking at a map of collective human emotion. The charts weren't random. They were a direct, visual printout of the repeating, natural cycle of our own fear and greed. And this quote from Elliott himself really just says it all. He didn't see the market as some artificial, man-made machine. He saw it as a natural phenomenon, governed by the same kinds of universal laws that create waves in the ocean. So, what exactly was this pattern he saw? Let's break down the absolute core of his entire theory, the 8-wave cycle. Okay, so what Elliott figured out is that markets tend to move in a very specific rhythm, a 5-3 pattern. The best way to think about it is like the market is breathing. You get 5 waves moving forward with the main trend, that's the inhale, and then you get 3 waves pulling back against it, that's the exhale. This simple 5+3 structure is the key to the whole thing. So let's look at the anatomy of this thing. You have waves 1, 3, and 5. These are your motive waves. They're the ones pushing the trend forward. In between them, you have waves 2 and 4, which are basically little pullbacks, or corrective waves. After that big 5-wave push is finally done, the market needs a real break. And that's when you get the bigger 3-wave correction, which we just label A, B, and C. And that's it. That's one full cycle. But this is where it gets really mind-bending. Elliott discovered this 8-wave pattern is a fractal. What does that mean? It means the pattern repeats itself over and over again on every single time frame. That huge 5-wave move you see on a yearly chart, well, it's made up of smaller 5-wave moves on a daily chart, which themselves are made of even smaller cycles on an hourly chart. It's like those Russian nesting dolls, just patterns inside of patterns inside of patterns. So you're probably wondering, what's actually causing this? Why does this repetitive pattern even exist? Well, for Elliott, the answer wasn't buried in economic reports or company earnings. It was all about us. It was about human psychology. See, each wave has its own distinct emotional signature. Wave 1, that's the smart money, the brave few getting in early. Wave 2 is that moment of doubt, the "is this for real?" pullback. Then comes wave 3. That's the big one, when the crowd finally catches on and jumps in, pure euphoria. Wave 4 is just people taking a breath, cashing in some profits. And wave 5, that's the last gasp, when everyone is a true believer, right before the top falls out. And this is the part that takes it from just a cool observation to a really practical tool. Elliott discovered that the size of these waves, how far they push up and pull back, wasn't random at all. They were often related by a specific set of mathematical ratios. specifically Fibonacci ratios. Yeah, the same golden ratio that appears everywhere in nature, from seashells to galaxies. The incredible idea here is that our collective social mood, our herd mentality, might actually expand and contract according to these same natural laws. He wasn't just mapping prices, he was mapping the math of the human herd.
All right, so we've got the psychology, we've got the math. Now for the big question. How do people actually turn this theory into practice and make real trading decisions? Okay, this table right here, this is basically the mathematical roadmap. Traders use these Fibonacci ratios to project where a wave is likely to begin and end. For instance, a classic strategy is to wait for wave 2 to pull back to about that 61.8% level of wave 1. Why? Because that's often the launching pad for the big, powerful wave 3. Now, understanding the corrections is just as important as the moves forward. Elliott pointed out a couple of main types. You've got the zigzag, which is a really sharp, fast correction, and then you have the flat, which is more of a slow, sideways grind. And he came up with a cool principle, the rule of alternation, which just suggests that these two types of corrections tend to alternate. So if wave 2 is sharp, you can probably expect wave 4 to be more sideways. So, all of this boils down to a few key principles for traders. The main goal is usually to catch that big, profitable wave 3. You learn to spot patterns like an ending diagonal, which is a classic signal that a trend is running out of steam. And maybe the most important rule of all, always, always have an alternate count, a plan B. Because let's be real, the market can and will throw you a curveball. Okay, final section. Why are we still talking about a theory that's almost 100 years old? I mean, in today's world of AI and high-frequency trading, why does Elliott's work still matter so much? Well, for one, Elliott proved its power himself. Back in 1938, he went public and, using his wave counts, called for a major market bottom. And you know what? He absolutely nailed it. That one call pretty much cemented his reputation and the validity of his work right then and there.
And his legacy? Well, it's literally everywhere now. If you've ever used a trading platform and drawn a Fibonacci retracement on a chart, guess what? You're using a tool that comes directly from Elliott's discoveries. His ideas are baked right into the foundation of modern technical analysis.
And that really brings us back to the central, powerful idea that Elliott gave to the world. The market isn't just a random walk. It's structured. It's patterned. It has a rhythm, an expression of our own human nature. I want to leave you with Elliott's most famous quote, because it really captures his life's work perfectly. He taught us to stop looking at the market as some cold, dead machine and start listening to it almost like a living organism. Because if you can learn to hear its heartbeat, you realize you're no longer seeing chaos, you're seeing rhythm.
Thank you for watching our video. In the next episode, we will examine the journey of another legendary trader. Don't forget to subscribe and turn on notifications. For more content and strategies, you can join our Telegram channel. The link is in the description. Stay well.